why should I trust you with my capital? How do I know that if something goes wrong tomorrow, you're my guy? You're the guy who's going to fix it. You're the guy who's going to figure it out. Or woman, how do I know that? And that's really what I think institutions are trying to figure out now.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, let us hear about it. Leave us an honest feedback, give us that rating and review. It helps us and also helps other listeners find this show and get the value you're getting. And if you haven't done so already, or this is your first time, be sure to hit that follow or subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Deborah Smith. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to CasmanCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to CasmanCapital.com and click on the Mastermind button today. Deborah Smith is the co-founder and CEO of the CenterCap Group, the first female-founded investment bank exclusively operating in real estate, and heads the firm's strategic capital and M&A and execution efforts. Now, prior to forming the CenterCap Group amidst the 2009 GFC, Mrs. Smith was co-head of M&A and a senior managing director of CB Richard Ellis Investors. She joined CBREI in July 2007 to co-head the build-out of the firm's M&A efforts and led the firm's negotiation and acquisition of a majority interest in Wood Partners. Let's welcome to the show, Deborah Smith.
Thanks for having me on. It's good to be here.
Absolutely. Deb, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, you make me sound very old. Although I'm told that I should say I'm older. I'm not old. I'm older. It's when you start having a lot of things you can put in bullet points on your resume, it makes me seem very experienced. So I've been around a long time, 25 years. I've been in investment banking. I've been in it my entire career. I'm Australian. I come over here with Morgan Stanley back in the late 90s and moved around to a few different shops before starting up our own firm myself with a co-founder who we'd been friends for a very long time. So it was very fortunate that we could start CenterCap Group together. We've been in real estate. I've been in real estate since 2005. My first deal was the Gables deal that did go private back in 2005. And the rest is history. And so it's been a wonderful ride. Our business continues to grow, and it's an exciting time to be in real estate.
I love it. You talked about 25 years of experience, all in investment banking, coming from Australia, and being in this space here in the United States and doing some really amazing deals. We're going to get into some of those deals and what you see in the marketplace in a moment. When you talk about, getting in 25 years ago to today, what are some of the big changes you've seen the industry take, particularly on the investment banker side?
Yeah, so over the course of my career, probably the biggest change has been the role of technology. And the role of technology, it's not, when I started, we had Lotus Notes. We didn't have cell phones, we had pages. There was no iPod, there was none of those electronics at all. It's the good old-fashioned telephone and the good old-fashioned in-person meeting. And so the world's evolved since then, but it isn't just about convenience and making things easier. I think it changes the dynamics of how people interact. It's changed the way business is done. And I think it's also changed expectations and priorities of what we expect and how that's flowed over, particularly into real estate. If you think about it, it's the role or the demand of the consumer for convenience, the demand for everything's got to happen today, the demand for instantaneous responses to questions or information that we ask. And it's made us impatient in that sense. And if you think through, particularly post-COVID, the implication for that, it's led to changes in logistics and last mile and, pop-up spaces like industrial outdoor storage, which many of these things are really a response to a changing world and a demand for convenience.
Yeah, technology has certainly played a big role, right? And you talked about the changing nature of the customer, the client. I remember when I first started my career, you could kind of have your own weekend, right? And not get
Yeah.
too
Do you
bothered
remember
by
those
it.
days? Do you remember that?
I do, and it got a little crazy for a while there. And when I went to my world as an entrepreneur, that was actually one of the things I had to learn really early on was like I've got to put up some like parameters, like otherwise you could
Yeah.
work nonstop and really never have a break. So I appreciate you sharing that. Let's talk about it from the way you all look at the business as investors, right? So you work
Hmm.
with those folks who are making
Hmm.
investments. You particularly have a background in M&A. Again, for
Hmm.
folks who maybe aren't as familiar, explain exactly the role you play when it comes to mergers and acquisitions in real estate.
Yeah. At a very basic level, it either a company comes to us and they want to buy another company. They don't know how to go about it. They don't know what they should buy, but they have capital. They're well funded. And the question is, well, how do I get bigger? And what is the best way to do that? And they really have no sense. No, don't know how to value it, don't know how to structure it, don't know who to go to, or how to manage even the integration post transaction. The other kind is it's the seller. It's a corporate will come to us. And particularly in real estate, it's where there is a founder or it's a family member and they may want to retire, they might want to step down, they may want to monetize. And so they need help figuring out how to do that. And a lot of times that could mean selling the whole company to another party, or it could mean, even if there is a whole company, that people, some of the folks or founders transfer with it and stay at the new company, or they redeem out and they look at it as an exit opportunity as opposed to take some chips off the table. But that's what it is at its very, very, very super basic level.
I think too, what's interesting for us, and many of our listeners may not have as much familiarity here, but it's really important for us to have this conversation because most of us are investing to create a better future, right? We're thinking about generational wealth. We're thinking about, we joked about the time, but like financial freedom and time independence,
Mm-hmm.
right? So we're
Yeah.
doing all these things, and many of us are investing in real estate, investing in commercial multifamily, and gathering up these assets, but not necessarily with a clear pathway or a clear plan of how we're going to exit. I think
Mm-hmm.
so many people just assume you're going to give these properties to your kids. A lot of times the kids don't want them, right? And that's just the properties.
Correct.
If you've got a business you've built with
Correct.
employees, which me and my peers are doing, well, now you have a whole other set of circumstances, right? Because some of these people may
Correct.
not be trained properly to run a business or to take that on. So understanding that exit plan. And on the flip side, many of us are trying to scale. And the only way we know how to scale is, well, just buy more properties, right? Or hire more people.
Mm-hmm.
But really, a merger or an acquisition could be another approach where maybe there's an existing company that you can acquire. So let's dig into that a little bit more, right? You focus on those folks who are maybe a little bit further along than where many of our listeners are today, but it's great for us to understand the pathway. Talk to us about some of the clients you work with today.
So the question in general is one that every business should be. If you have a P&L and you have a handful of assets, you should be thinking about this stuff. It's you're talking about creating generational wealth for the future. What future? What is that supposed to look like? Do you have a plan as to what that's supposed to be? Do you know where you're going? Right. And so if you're just accumulating, the question should be is why? And does that asset or does that property fit into where I'm trying to go? And it's not, and whether you're a company that has $1 million or you have $10 billion, the question is still the same. Where am I going and what am I trying to achieve? Right. And if I'm trying to think about an exit, how am I going to get out of all this stuff? And particularly if you're a family, it's a family business, you are right. A lot of times there is no family, that the founder has dreams and ambitions that their children are going to be involved. That you more often than not, they're not. And so then you have this business. Well, the question should then be is how integrated is the business to you? If the business is dependent on you as the founder, that harms the value creation of your business. Why? Because if someone's coming in to acquire you, that you either have to agree to keep on working because the business revolves around you. The holy grail, in some ways, is to figure out how to grow your business with the concept of it not being entirely dependent on you, so that you have a succession plan or resources across the platform that you can leverage, right? So that you can grow, so that if someone else comes into the business, then it isn't dependent on you. And so therefore the value of your business isn't tied to you. And that's the piece you need to uncouple, is it's creating sustainable long-term value. And I think that's really important as any founder thinks about it. It's even if you want your kids in the business, is to be mindful that you can have it to you. You have to figure out how to, whereas you build out your organization to extract yourself from many of those day to day, and then over time to even extract it even further. A lot of people don't do that, and they should, because in part, what that ends up requiring is you need a real infrastructure behind to do that. You need an infrastructure. And what we tell our clients as they grow and they're looking for institutional capital, particularly, it's that you should ask yourself, could someone, a new person, start at your firm tomorrow and know exactly the way you run your business without a single person talking to them? Can they do that? Do they know how you underwrite assets? Do they know who they go to on property management? Do they know who your vendors are? Do they know how you want this thing run post-close? And if you don't have the written framework to answer those questions, then it is difficult to grow your business of any scale. It just is.
Man, you get some great feedback there, right? So understanding what that end game is, no matter if you're at $1 million or $10 billion, what's the end game? What does it look like? And as an investor, as an entrepreneur, as an owner operator, the one thing you have to do is figure out, how do you extract yourself from the business? You talked about make
Correct.
sure you have the systems and processes that it's written so that a new buyer and a family member,
Mhm.
whoever, could step in, take over, and know exactly what it is they need to do, because that business plan is written down, right? They know who the vendors are. They know how to acquire customers or
Correct.
clients. They know what to do. That's going to make your business more valuable if they can move you out
Correct.
of it and there's still value. So love that
Correct.
point there. You talked about kind of institutional level investors and institutional capital. Talk to
Mhm.
us about playing the game at that place, right? So your clients are investing typically hundreds of millions of dollars into these
Correct.
deals. So this is an area that many people would aspire to reach at some point.
Mhm.
How do you play the game at that level? Like, what are some of the differences that you see with these investors with institutional capital that maybe is missing for those folks who work with maybe high net worth individuals or even friends and family?
Yeah. Well, it comes down to a few things. It's not just organizational. It's to work in the institutional world, you do have to have strong organizational practices. And we talked just a second ago about investment committee and as approvals of spending capital. It's about how you regulate your underwriting, your exit, your management practices for the individual assets. At corporate, that can mean having mission statements, compliance manuals, risk management policies, making sure all of your track record is up to an institutional standard if you're buying and selling assets, having good financial records. All of these things go into having well-structured companies. And the bigger institutional owner operators of apartments, they have those things. And so what happens is if they could hire a new entry person across the country, and that person can start and know how that firm does business each day. And that's where you need to get to, because you can't. It's very challenging to raise institutional capital without that infrastructure and systems in place. As a separate issue, it's a lot of folks don't appreciate that if you're buying assets and you're using high net worth capital, those assets may not be suitable for institutional capital. And I'll take a super easy example. If you're collecting checks and it's a $2 million equity check to pay for a property, an institution isn't interested in that because they could be managing $1 billion fund. They can't look at folks that are putting out a $2 million check because they have a 3-year investment period. They can't, if they're putting out 2 millions at a time, they'll never put out all their capital, right? So that's why, in part, why the institutions end up gravitating to bigger checks and bigger deals, is they've raised capital themselves, and it's hard for them to put it out unless they put out in bigger chunks. So what that means is your check size in some ways dictates the types of assets. Now, if you're in a market and you're chasing down properties with 2 million equity checks, you have a certain network certain types of relationships, and a certain type of underwriting expertise. That may not be transferable to an institutional product, which has bigger assets, different market, and may involve different standards and different kinds of relationships, right? And so we all know real estate's a relationship-driven business, but all because you're raising, smaller checks. To be institutional doesn't mean you just raise more $2 million checks. It means you have to have a bigger asset with a bigger check, is how that translates. And a lot of folks don't understand that. But we should all just keep in mind too, that if you're in the high net worth capital sector, and that's where your capital is coming from, you don't have to move to the institutional world. A lot of our clients and people who come to us have reached a point on the high net worth spectrum, and they feel the need to go out and raise institutional capital because at that point in their business, that's what's required to take it to the next level. But you don't have to always go that path. Lots of billions of dollars of capital have been raised through the high net worth channel. So the first question should always be is understanding who you are, understanding what your capabilities are, understanding what you're good at, and whether it's really worth it to you to go down that institutional path, because to do so is a big investment of time, it's a big cost, and it's a big allocation of resources away from what you're doing in your day job.
I love it. You talked about really understanding that in order to go the institutional route, it's more organizational, right? I mean, this is pretty much a corporation at that point versus more of a mom and pop or even kind of a well-structured smaller company. You're now talking about an organization where there's policies involved, there's underwriting rigorous, like there's all these steps where it's meant to be a system that is followed and not just someone taking a look at a deal saying, oh, I like that, let me write a check. There's a whole process. There's a committee that has to approve it. So there's certainly more steps involved here. I want to rewind a little bit because some folks, again, may not understand kind of the tiers. We're throwing around terms like institutional capital, high net worth. I mentioned friends and family. How would you kind of, describe those tiers of capital from your standpoint?
Yeah, and for us, I'm not sure there's an exact universal definition, right? Because you have accredited investors, family offices, pensions, endowments. I mean, the list goes on of types of players. We always look at it for us, if it's a $10 million equity check or greater, we think it can work within the institutional market. If it's not, then it tends to be non-institutional. Now, my one caveat to that, which is an interesting trend we're seeing particularly now, is the rise of like niche products of real estate. And even within multifamily, that could mean active adult living as a spin out, or it could mean manufactured housing, right? Or modular housing. There's variations even within multifamily that make it so it's not as uniform as it used to be. And I raise that because those niche products tend to have small checks. And historically, they have not been regarded as institutional. But in some ways, the way something can become institutional is if you have enough owner operators out there, because an institution is not going to come in and hire a management team, to do 2-3 million checks. But what happens is, and this is what happened with student housing, so it's a super easy example, is that when you have a whole bunch of owner operators, they go out and they're buying all these 2-3 million checks with high net worth capital. They amass a portfolio that has scale, then it's institutional, because the institutions will buy a big block, because then you've got a lot of assets and the equity check across all of them is material, right? Then it becomes an institutional product. So we're seeing that now. We see it particularly in active adult, which is one that's been around, is really popped up. It's amenitized housing. We'll call it amenitized housing for the elderly. These things are really cropping up. Manufactured housing is another one as we look at affordable housing crisis. They're popping up and folks are paying attention to it and are looking for owner operators that have portfolios of assets, even if they're high net worth backed, as a way of getting into those spaces, capturing some return because there's less institutionals in it. And that's a space they're interested in. And for owner operators, it's interesting because whatever they pay for those individual assets, there could be a portfolio step up in value, right? Because they've done all the work in rolling it up and getting that portfolio together. We're seeing that now. Self-storage is another one. The exact same thing happened where the checks are super small, but if you get enough of them and you can assemble a portfolio, then you've got something of interest to an institution.
I love that. And I want to play that back because I think that's really insightful for our listeners. You talked about understanding that, really there's lots of terminology, but ultimately at that $10 million mark, that's really where you start to have an institutional level product that investors are going to be
Mhm.
looking for, right? Underneath that, whether it's a family office, friends and family, high net worth, it's all kind of similar. Where
Mhm.
there's real value, though, is the accumulation of a portfolio. So
Correct.
even if you're an investor who's maybe doing syndications in $5 million deals, right? So you're raising $2
Yeah.
million for a $5 million deal. That's not ready to go to institutional investors at this point. However, if you're doing this for the next 10 years and if you just acquire one asset a year for the next 10 years, well, now you have, $50 million worth of
Correct.
real estate. You've got $10 million of equity that you've put in. You'd assume that it's gone up and appreciated in
Mhm.
value over that time. And what you're saying is that by taking the process of accumulating this into a portfolio, most institutional level investors are actually going to see that there's more benefit and more value in that. So there's going to be
Correct.
a little bit of a premium, even
Mhm.
beyond just selling these as, 10 individual properties. So there is value in accumulating a portfolio. So as you're thinking about that exit strategy and the plan that you're putting together, this is something you should have in mind because, as you said, that institutional investor, they got $100 million, 100, $1 billion, whatever it is. They have huge checks they have to write. They're not trying to write 50, 100 or $10 million checks or $52 million checks. They can't do that, right? They can't
Right.
evaluate that many deals or opportunities. So they'd rather write bigger check sizes, and they're really trying to make sure they're partnering with the right people. Talk to us about that, right? Like when you're evaluating these deals and opportunities, you have a lot of money to deploy. It almost feels like a good problem to have, but there's still a problem, right? So what does that process look like on evaluating the deals or the partners, operators that you're looking to invest in?
Yeah. So once you get to, if you've got a rolled up a portfolio, then there's a conversation with institutions, right? Because they can put up capital today. And then what they can also do a lot of times is they will want to provide capital to continue growing the business. And so that is your ticket into the institutional market is if you've got something that can be seeded, we call it seeded, where they can deploy capital today and then allocate capital to continue growing the business after that. There is a real conversation there. And depending on the product and depending on where your expertise is, will determine how many institutions would be interested in that. But has been a movement along with these growth of these industries in the number of corporates, funds and fund managers, et cetera, that are willing to underwrite corporate deals in order to get access to these types of assets and then to grow them. And then ultimately, they can go public, you can create an operating company and sell it off. But as that company grows, you end up have to have an infrastructure that oversees it, right? So you end up with employees, you end up with a team, you end up with an organizational chart, and all these things that go along with managing large tracts of real estate. So now you have a real company. And so you can get valued for the company in addition to the assets that the company owns or the company manages. So I think that's right. I think as companies grow, and in some ways it becomes natural that you have to put in the infrastructure and you have to put in some of these things, otherwise your company it becomes a chaotic mess, right? And so you have to, and it's better just to get onto it earlier because it won't cost so much to put all this stuff in place if you just grow your business with that in mind. And then I think it prevents less mistakes on a go forward. But I think to answer your question, when an institution comes in, what they will look at is, and what we're encouraging our institutional clients to do today, is that a lot of folks have had a very, very strong performance track record since the GFC, right? A lot of folks have high teens, 20 IRR portfolios because money was free. It's almost a case of if you did not have a strong performing portfolio, what was wrong with you? And so it's a little bit of that. So now we see, and every company that comes in through our door has a great track record. And so now the question we encourage folks to ask is, if I take away your track record, tell me who you are. Who are you? If I take out just the sale of assets and the lenient in as I generated, a 2 times equity, if I take that off the table, what are you going to tell me? What's your story? Who are you? What are you trying to do? Where's your capital coming from? How do you philosophically look at the business? How do you underwrite markets? How do you pick assets? How do you say yes to that and no to that? What are the mistakes you've made, right? Who is your management team? If something happening tomorrow, can they run the business? It's all of these questions that become more important today than they've been at any time in the past 10 years. And so I think a lot of folks are laser focused, and we encourage them to be laser focused. Is finding good management teams that if something goes sideways tomorrow, and everyone's talking about, distress and the number of, loans that are coming due, and oh my gosh, how are we going to finance all these loans? The question really is why should I trust you with my capital? How do I know that if something goes wrong tomorrow, you're my guy? You're the guy who's going to fix it. You're the guy who's going to figure it out. Or woman, how do I know that? And that's really what I think institutions are trying to figure out now.
I love that, and I think that's very applicable for all of our passive investors as well, right? You talked about the track record, and it's an important thing, certainly, but so many people have had a great track record since 2011 that there really isn't a lot of value in just simply looking at someone's track record. And to the point you made, if someone doesn't have a good track record over the last, 10,
That's more
12
telling.
years, that's probably a really big red flag, right? Most people have
Yes.
done really well over the last 12 years or so. So go beyond the track record. What's their
Yes.
story? What's their
Yes.
vision? How do they decide we want to invest in these kind of assets and not those kind of assets? Do they have a clear vision? What happens if something happens to them? Do they have a good management team in place? I think these are great questions at every level, institutional level or even an LP. If this is your best friend, I think these are still really good questions to ask. And I think the most successful people, they do have a clear vision, right? They
They do.
pick an investment thesis, they have a criteria, they have it for a reason, not just because they
Yes,
read in a
that's
book
true.
or, they lived their mentor did it, but they
Mm-hmm.
developed and crafted their own thesis. And I think that allows you to see success more. Is there a question or I guess an attribute that you kind of look for to know, hey, if I see this or if we get an answer like this, it's an automatic no. Any like automatic no kind of red flags that you look for?
Yeah, in this business, there is a separation between an ability to invest and an ability to run a business. Those two are not the same thing. And we have learned that over the years. And I underwrite management teams for a living, right? It governs every aspect of our business. How do I know that they're a good management team? And sometimes it's just asking our questions around, they how they look at investing. That is true, because you're looking for discipline. You're looking for how involved are they in every aspect of decision making versus trusting others. You're asking about, well, why that asset versus another, but not just for the quality of the asset, but do they have vision? Do they have an investment thesis or a strategy that they're dedicated to? We have clients, and assets come in all the time. And our question is, yeah, but this doesn't fit on strategy. And it may be a great deal, but that doesn't mean you should be the one to do it. Right? And you can do it, but just keep in mind, it is not on core on who you are. And sometimes the best decisions are when you just say no and say, that's not who we are. That's not what we're focused on. And having some clear discipline around the decisions you make and being deliberate in how you build your business. Those things are things that we're looking for. I always look for some degree of authenticity. Are they, how thoughtful are they about their day-to-day decision making? How thoughtful, but at the same time, how visionary are they about where they want to go, and how they want to get there, and the decisions they think they need to be made, and whether they have vision in that. And particularly for CEOs, sometimes CEOs, they may be great investors, but that doesn't mean they're great managers of people. And so that's something we constantly look at too. A lot of it, unfortunately, is a lot more. I've just been around for a really long time and I've been doing this. So I've seen a lot of management teams to help me inform what I'm kind of looking for and what makes me feel good about the kinds of folks that we work on. But hopefully that's some guidance for your listeners.
I love it. Well, listen, if you want to learn more, you've got a great, wealth of information, Deb, and I'm sure that your team can help so many investors. Go to centercapgroup.com. That's
Yeah.
centercapgroup.com, and you can learn more and connect with Deb's team there. Right now, we're going to transition to our round of insights. Deb, give me a failure or an apparent failure that set you up for later success.
Well, I had to go back to college. And I just made this comment last week to one of my colleagues. I wish I had a majored in accounting when I was in college. I wish I had done it. Instead, I went to law school, and I think about it constantly, whether I should have gone back and whether I can get an abbreviated degree. And I'm older now. We've decided not old, whether that's a good decision, just because it's something I wish I had have always done.
All right. Give me a digital or mobile resource you recommend for your business.
Oh, well, without question, I'm a Wall Street Journal girl. I have it on my phone. I have it on every device. Now, I still go for the paper version too, but that's the way to go.
Give me the book you've recommended or gifted the most in the last year.
House of Cards, William Cohen. It's a great read. I was at Lehman during part of that, but it is entertaining. It's well written. I have it on an audio book, so it's great.
What's a daily habit that helps you stay focused on your goals?
I run a lot.
All right, I love that. Give me your number one insight for investing in new businesses.
Pay attention to the downside. Don't assume it's just going to work out, and don't assume the exit will figure it out. If you're going to look at any investment, think about what it is you want to do with this thing on the back end, and think about all the things that can go wrong. It may look good, but you really do need to pay attention for when things go sideways, because that's what separates the people who survive versus don't.
I love it. And you gave us some great information. Let's lighten the mood here. Where are you located? I know you're from Sydney originally, but where are you at now?
Yep. We're based in Stamford, Connecticut. We were city-siders for the longest time before we moved out during COVID. Best decision we made.
Love it. All right, Stamford, Connecticut. Give me your favorite place to grab a bite to eat.
Well, I'm going to go back the other way. So Stamford, Connecticut, when I'm in the city in New York City, I love to go to the Fitzpatrick Hotel, actually, which will be a new one for folks. It's quiet. They have a great cup of tea, and I think the food is really good.
I love it. We'll have to check that out next time we're in the city. You gave some great information, Deb. I love hearing a little bit more about your background, 25 years in investment banking, and learning really what you've seen over that time frame and helping different companies merge and go through acquisitions. And the big thing is, if you're a business owner, if you're an investor, have a vision. It's not just enough to accumulate assets, but try to figure out where you're going. What is the exit plan? What are you building towards? And how do you make sure you're taking the appropriate steps so that that succession plan is there, whether that's through selling the business, whether that is through, again, preparing your family members or whoever else to take it over. You have to put those systems and processes in place, write down the plan. It's going to help create value. And whenever we're trying to work with institutional level capital, recognize that they're looking to buy a business, right? It's got to be organized. There's a whole process in place. You have to be very professional when you're dealing with these kind of investors because they have big checks to write and they want to make sure they're making the investment in the right group, the right managers, not just the right investors. You by yourself might be excellent at finding deals, but if you can't replicate this and show how your team has a clear process, it's going to be hard for them to want to invest in you. Great information, a lot of things that I think all of our listeners can take and apply to their own business or their own investing journey. Again, if you want to learn more, you can go to centercapgroup.com. Deb, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.